In your recent video with Tom, you shared the possibility of Seritage trading at around $5 a share. And lo and behold, your prediction came absolutely true. Not only that, but at the time of recording, it is trading at $12 a share. Eddie Lampert, the former chair of SRG, also changed his LP shares into Class A commons and voted to sell all of the company's assets, distribute the net proceeds to the shareholders, and dissolve the company. Matthew, the investment experts watching the show would like to know how you've used options in your Seritage investment case.
That is an excellent question. And again, I talked briefly about I want to preface this by saying it's unusual for us to talk so openly about these current holdings. There are commitment and consistency biases, etc. However, this one has been so uniquely controversial that we have been a little more public about our views on this. In fact, there's quite a bit of short interest. There's quite a few people who are claiming this is sort of a bankrupt company. And, you know, we are very aware and watching this scenario. Our views differ considerably, as I've explained. So what is happening today with Seritage is actually different than what was happening even during the interview with Tom. So basically, if I take a step back and look at Seritage, as many reviewers know, is this ex-real estate spinoff from Seritage Properties. And to get a full understanding of what Seritage is worth, we had to go through the original 212 properties. These are large, complex, sort of commercial type buildings, mall, retail centers, sometimes standalone units with multiple activities taking place on these properties. So they could be overparked, they could have development plans, they could have new entitlements in play. And we had to value every single one. That doesn't seem maybe too onerous, but if you spend a lot of time with a single property, you start to really become familiar, and there's only 212. So for us, it doesn't seem onerous, but I think, you know, it can take someone quite a while. We've gone through every property. We understand quite clearly that there's about 3 to 4 billion in value within these properties, depending on a certain amount of factors. And they have about 1.5 billion, and that's a pretty conservative number. They have 1.5 billion in debt, mostly to Berkshire Hathaway, and then about 77 million of these preferred shares. And there's 55 million shares of stock outstanding. So you just divide, you know, the value of the properties by the price, and maybe filter in some factors for probabilistic risk scenarios. You get a highly positive scenario where the shares should be trading for sort of $25, $26, $27 a share, and they're sitting around at 10. So, you know, this is a great value type opportunity. And what's happened since the interview with Tom is that management has come out. Eddie Lampert's converted all his shares, et cetera. I think maybe that was just prior. And they've come out and they said, we are going to liquidate the entire business. So they have brought in new CFO, John Gorelli, who has experience in these full liquidations, and he creates a lot of shareholder value when he does these liquidations. And they're trying to section off individual groups of properties and individual portfolios, and they're just going to sell this company. So this will not be it will be a little bit of a roller coaster. There will be some properties that maybe were expected to receive a certain price, they get a lower price. There may be delays, there may be trouble, but ultimately I expect this will be mostly successful. They are just going to liquidate properties we've seen the value of properties run up so much in America over the last 2 years. we've had interest rates low, we've put money out everywhere, and there's inflation going on. These properties have quite a bit of value, and some of them are extraordinary properties. They have these premier mixed-use properties in places like Santa Monica, places in Miami. These buildings are really valuable. And they have others that are not valuable. That's okay as well. So as they begin this liquidation process, and management has, I believe, sandbagged the number, but they've announced clearly that I think $18.50 to $29 a share is what they expect to hand out in cash over the next sort of 36 months. Maybe it's a little delayed. Maybe it takes 48 months. Okay, so what I was suggesting with Tom, and this still exists right now, it's quite remarkable. We have a full position. We have it's actually quite a large position. I will share with you that, when it was dipping down to, you mentioned the 5 price, we were being put a lot of shares because we were selling puts and they were being exercised. We were being put shares. So we had about a 15% position, and that's now doubled. So it's, maybe it's 30% of the portfolio right now. And that's a large position. And we actually expect it to naturally all become cash. So it's a beautiful holding. It will all slowly become cash. We'll receive distributions and payments until this liquidates. And from this point, we expect maybe we get about 150% or more from our current holdings. So it's quite an interesting scenario. Now, let me explain how fantastic this is with the put and call and the puts that I just mentioned. So Black-Scholes is the common model used to price these, and the factors in Black-Scholes are very quantitative. There's no qualitative aspect to understanding that the CFO just switched from essentially a CPA accountant type to a very active handheld liquidator. So there's nothing in the Black-Scholes that asks that sort of question. Black-Scholes just looks at volatility, and the price of options are highly correlated with the volatility of those shares. And because there's so much uncertainty, and uncertainty and risk are two distinct things. Uncertainty is maybe an unknown outcome, but the outcome in either scenario could be okay. Risk is like the risk of a permanent loss of capital. So there's a lot of uncertainty with Seritage. We don't know, are they going to be, we don't know how successful the liquidation is ultimately going to become, but we do know that the odds are in their favor of it being quite successful. We don't know if Eddie Lampert tries to make bids for certain properties. We don't know what's going to happen exactly. There's a lot of uncertainty around it, but we do know that the outcome from John is probably going to be very valuable to the shareholder. And so as the shares are now volatile, trading at 12, you could actually go out and write about maybe there are 5-month contracts available out until about January of next year. And if the shares are trading for 12, you might be able to pick up $2 or more in premium to buy just right now at that price. And that's so attractive because not only could you put in a price to buy it at 12, maybe you could also, during a dip, put in a price to buy it at 10 and ask for an outrageous price. You might even be awarded $2 with a $10 strike if the price declines for a little bit. In that scenario, you're going to be in a position where you're making sort of a 25% premium over a 5-month period. It sort of becomes like 60 or 70% annualized. And it's just an incredible return, and you might not even be put the shares. What's interesting in a situation that, and I'll actually talk a little bit about this. So there's all sorts of things that happen when you actually put this into practice. In theory, nobody would exercise their option before expiration date because they've paid for time. Theta is one of the factors that they're paying for. So if you've paid for time, you wouldn't actually exercise before the time expires because you could just let it play out and see what the end looks like. So we write these contracts, but market participants aren't always rational. Some of them are levered. Some of them have other mandates taking place. And so when shares come crashing down, we get put our shares early. People get scared. They want out of the position. Maybe there's leverage. So we have these outstanding contracts that maybe didn't expire until January with a strike of, say, 10. And as shares dip to 6, because everybody's fearful, one, our conviction, because we've done the analysis, we understand that they have cash in the statements. We understand that there's not a liquidity issue at the moment. People are afraid of a liquidity event happening next July, which is a very unlikely scenario because there will simply be a restructuring to Berkshire, if at all necessary. So there's not really a liquidity issue, but everybody's afraid of a liquidity issue. And as the shares dip down, we were put a lot of the shares affiliated with the put contracts we have sold, which is exactly what we want. It feels a little uncomfortable because prices are falling, but we're being put shares. And then, of course, they've now rebounded over the last sort of month and a half. And we're sitting here with shares that we bought for $6, $7, $8, $9, and they're trading for $12. And we expect that we'll be given sort of $20 to $25 or more dollars in cash for the shares that we just recently purchased for $6 or $7 or $8. So even today, the opportunity still exists. We have a totally full position. If we had more cash, we would be selling more puts on Seritage. It is a very unique situation where a company is going to go to full liquidation, bring us back to cash. We'll be able to reallocate that capital in 3 or 4 years. But right now, we're looking at a very clear sort of triple on a very secure position that's basically owns a whole bunch of U.S.-based real estate and very attractive real estate. So we're very happy with Seritage's position. It's volatile. It's controversial. People tweet at me quite often that my theory is wrong, but I think the future will show us. And it looks like a very attractive situation if you utilize the sale of a put as a tool to buy the stock. You can sort of be picking up 30, 40% annualized on those IRRs right now.